Thank you for joining us. Let's get into our conversation now. Governor of the Central Bank, Dr. Yemi Cardoso, has acknowledged the current challenges the country is facing. He says he's confident that positive outcomes are emerging and will become more apparent in the near future. Governor of the Apex Bank spoke when he appeared before the House of Representatives earlier in the week. Mr. Cardoso noted that the CBN is working tirelessly to bring lasting solutions. Quite a lot of issues were addressed by the CBN governor and the finance minister during their appearance before the House of Representatives earlier in the week. Let's get talking now. I'm joined by Professor of Finance and Capital Market at Nasarawa State University and President of the Capital Market Academics of Nigeria, Professor Uchenna Waleke. Thank you for joining us, Prof. We appreciate you for coming.
Thanks so much, Frank. My pleasure, always.
All right. Given the current economic challenges, how realistic is the CBN's target of achieving a 21.4% inflation rate in the 2024 fiscal year?
Well, the first is to note that I think we are beginning to see a convergence of monetary and fiscal policy targets. In the past, you would have different targets set by both the central bank and the government. Central bank would set GDP targets different from what the government is doing. Central bank will set inflation target different from what the government is saying. But interestingly, the fiscal and monetary sides are, speaking one language now. In the 2024 budget, the target is 21.4% inflation rate. And all the statements by the central bank governor in recent time, point to bringing down inflation rate from where it is today, 28.92%, let's hope the peak has been attained, to 21.4% at least by December. On whether it is realistic, I think the answer is yes, it's achievable. Again, if you look at history, historical evidence, we've had periods in this country when inflation rate was even as high as 72%. In 1995, Frank, inflation rate was 72%. 2 years after, in 1997, it came down to single digits. The same for 2005, when inflation rate was as high as 54%. Now, by 2007, inflation rate has also, had also come down to, a single digit. But again, what is discernible from the trend? I was looking at the inflation trend from 1960 to 2003. If you go to macro trend, the website, you will find that. So you will realize that the peak has been the year I mentioned, 1995, 72%. The least lowest we've had was in 1963, and then later 67, when inflation rate was actually negative. Negative inflation means we had deflation. Deflation is a situation in which you have persistent fall in price level. Inflation is persistent rise. Deflation is persistent fall. So we had deflation in 1963. Again, it's not difficult to see why. The country was then, I remember Agric was the mainstay of the economy, and forex wasn't an issue, Naira was stable. So you now find that in all of this, usually when inflation rate is coming down from a peak, what aids that, what supports that is, or what enables that, has to do with, one, the issue of your currency and the Naira, how strong is the Naira. Secondly, the issue of borrowing, government borrowing. In 2005, for example, you recall, we are carrying very high public debt. Borrowing was high, external debt was high, but that was the year Nigeria exited from the Paris Club debt, 2005, 2006. So that exit from the debt burden or the yoke, enabled us to achieve single-digit inflation 2 years after. Okay, so I'm also saying that 21.4% is realistic for 2024 if the government will take into consideration these things I've mentioned, including the third one is output, and in particular agric output. Okay, agriculture was booming in 1963, so we had deflation. Agri GDP was strong in 1997. Agri GDP was strong in 2007, when we also had single-digit inflation rate. Because come to think of it, the major pressure or the pressure point, has always been food. Okay, not necessarily the core items, but the food component. So it has always been there. So if we can get around this food challenge, food security, I am of the opinion, I am positive, I'm optimistic that inflation rate will come down, and that 21.4%, will be achievable. So all that the government needs to do will be to focus on the agri output, which I mentioned earlier. Also focus on stabilizing the naira and even bringing down the exchange rate. It's not about even, people talk about stability, but stabilizing at what price, okay? If you stabilize at a high equilibrium price, okay, it still doesn't, solve the problem. The naira needs to be stronger, so exchange rate needs to come down. And then, of course, the third leg that I mentioned has to do with borrowing. Fiscal deficit has to be less, government has to borrow less. And one of the things the government can do, to reduce the fiscal deficit, move towards fiscal consolidation, is to use the current exchange gain that all the tiers of government are enjoying now, to see how to reduce the deficit. Okay, the budget has been based on $800 per barrel. Exchange rate, 800 naira to the dollar. All right, the exchange rate is now as high as over 1,400. So you now find that both the federal and state governments are getting more money in terms of FAC. FAC receipts these days usually exceed $1 trillion. So the proportion that represents the gain, in my view, whether at the federal level or at the state level, should be used to reduce the deficit, to reduce borrowing. By the time you reduce borrowing, you make it easier for the central bank to even, implement monetary policy. So by and large, Frank, this job of bringing down inflation is not just about the central bank. Central bank can't do it alone. I keep saying it. The government must, be involved to ensure that inflation rate comes down. It's the government that handles agriculture. It's not the central bank. It's the government too. It's the central bank, yes, that will look at exchange rate. But again, the government too has to be involved. And it's also the government that will reduce borrowing. It's not the central bank. So the two must work together to bring down inflation rate. And I think it's realistic. I think it's possible.
Three things you've highlighted, Prof. Borrowing, activities in the agri sector, and the FX management. Well, let's take it from the food issue that you talked about, the agri development. While at the House of Representatives, Mr. Cardoso mentioned that the plan will be to aid what they are doing by improving agricultural production to ease the effect of global food inflation on the nation. Again, isn't this a fiscal role? How do you harmonize the synergy between the fiscal and the monetary authorities in terms of what their role and programs should be?
Yes, I'm glad he even mentioned that, because before now, the body language is, I won't touch anything development finance. That's the fiscal authorities' remit. I want to focus on monetary policy. But the reality today is that the central bank, cannot completely shy away from trying to support growth, because the real challenge, as I've always argued, is not even just inflation. The real challenge is stagflation. You have a situation in which inflation rate is rising, and on the other hand, GDP growth rate is weak. Unemployment rate is rising. Okay, people are not having jobs. Okay, cost of assessing credit is high. So in the midst of all of this, central bank too should feel concerned. And that is why I'm happy that both monetary and fiscal policies today are, talking to each other. Today we hear, unlike previously, that the central bank governor, has regular engagements with the minister of finance and coordinating minister, for the economy. So they should continue to talk. They should continue to seek ways to bring about, a solution to the myriads of challenges we are having. As I said, it's not just inflation. We also have the issue of growth. Central bank can't sit back. Yes, in terms of interventions, we've had a raft of interventions coming from the central bank. Of course, the problem, in my view, with all of them, has more to do with monitoring, has more to do with evaluation. So, as we speak, I am not too sure, to the best of my knowledge, that there is any comprehensive, up-to-date report on the outcome of all those interventions, including the one that was generally perceived as as successful or relatively successful. That's the anchor borrower program. No report on the outcomes, of that. So I'm sure that's also why the central bank governor is not too willing to embrace that. Again, given the fact that all those interventions to a large extent were also distortionary. So when the central bank governor says he wants to focus on monetary policy, I think one can understand that understand him from that angle. But that doesn't mean that the development finance function of the central bank, as enshrined in section 31 of the CBN Act, should be petitioned. Central bank has a development function, and given the fact that our development banks are development finance institutions, like the Bank of Agriculture, for example, okay, until it is resuscitated, until these other ones are resuscitated, the central bank should not fold its arms and watch. Occasionally, I expect the central bank, to intervene. But of course, I understand that the central bank balance sheet at the moment is challenged partly because of the huge ways and means that also went out during the last regime. Today, ways and means is as high as 30 trillion naira. Okay, that kind of debt, that kind of obligation of the FG to the central bank, of course, is hurting the central bank, balance sheet. Now, it has been stretched for 40 years at 9% interest, but it's still a problem. The central bank has to grapple with. So it has weakened the central bank's ability to do those interventions that it ordinarily would have maybe loved to do, which is also why I think the CBN governor is saying that he won't be very much involved in it. But to say that the central bank will not do it at all, I would advise that the CBN governor to find a way of looking at those interventions, reviewing them, and any one of them that he thinks, makes a lot of sense, he should continue to pursue it. Why not losing sight on his primary mandate, which is maintaining monetary and price stability?
Prof, recall that the president is targeting a 3.75% GDP growth in the 2024 fiscal year, and this is higher than the World Bank's 3.1% forecast. So economically speaking, what level of inflation would you say is in line with the government's broader objective of economic stability and growth for the year 2024?
Yes, it is only a study, an empirical study, that can determine that. I don't think anybody can tell you offhand that this is the level of inflation that will enable a GDP growth rate of 3.76 as we have in the budget. As I said, it's only a study that can establish that. But let me also say, I'm sure you know this, the central bank has a band, a long-run inflation target band of between 6 and 9%. So the central bank expects in the long run, or desires that in the long run, inflation rate should hover between 6 and 9. Most central banks, of course, do that. They have targets. In US, for example, the UK, all right, their targets are 2%. The US Federal Reserve has a target of 2% inflation rate. Ditto for UK, ditto for the European Bank. In South Africa, it is a range between 3% to 6%. Inflation target in Nigeria is between 6% and 9%. So these things are normal, within the framework of monetary policy. You should have a target. But I also recall there was a time I ran into this study that was also done by the staff of the central bank with regard to what level of inflation can sustain, growth. And that study came up with 12%. So once inflation rate, but according to that finding, the finding of that study, if inflation rate is above 12%, then it does not enable growth. So it needs to be below 12%, okay, within 12% to be able to support growth. 21.5% is still high, going by a target, but of course, that is only a step forward. Okay, I'm sure the central bank has a plan or a program to bring down inflation rates ultimately in the medium term to at least a single digit. Single digit inflation is actually what enables growth. Once inflation is high, double digit, or even more than 20% as we have it today, then it complicates economic management. The disadvantages or demerits of inflation, we cannot overemphasize. You can see what is happening, today. Part of even why you have this pressure on the, dollar, in the forex market. It's also because of inflation. If inflation is eroding the value of the naira, people now tend to substitute, tend to look for currencies they feel they can also use as store of value. So these days, what is happening? The demand for dollar is influenced not just by transaction purposes. People are even spending dollar in Nigeria, and I'm happy the government is now, waking up to that. And they also speculative purposes. All right, and as in terms of function, people demand dollar as a store of value. That is why you find people trying to keep their assets, in dollar because they feel it's a more stable, currency. So we need to also have some semblance of stability in the naira, bring down inflation rates so that people can also have confidence, in the naira. Inflation distorts a lot of, macroeconomic decisions. But in doing that, again, I have to say this: the central bank should also tread with caution. That is why it's important, and I'm happy it's already happening. The central bank governor and the Minister of Finance are discussing. The two of them must agree. Central bank must not, use a hammer to kill. How would I, describe it? Why am I saying this? Just the other day, central bank issued treasury bills. 1-year treasury bill at 19%. Okay. Before now, it was just around 11.5%.
Let me just cut in. Yeah, just pardon me to cut in, Prof. I mean, there are quite a lot of things that we need to look at, but time will not permit us. You talked about, borrowing. And some people will say, look, the CBN must be cautious in the way it prints money for the government. I mean, in terms of way and means advances now, there has to be caution there. Some people have also spoken about that. And then in the area of exchange rate, some analysts or experts have said, look, that should be perhaps, that should be given to the fiscal authority to determine, to decide what the exchange rate will be. So I needed to speak to these issues before I let you go. And secondly, looking at global economic trends, give us your outlook on GDP and inflation rate as food prices has continued to rise. Because if you look at food prices today, it's around 33%. I mean, food inflation is around 33%.
Yeah, Frank, your first question is on ways and means. Of course, we have seen the devastating effect of the huge ways and means that entered into the economy, as I said earlier, on 30 trillion. The first tranche that the National Assembly, approved for securitization was 22.7 trillion. Then another 7.3 trillion, has also been approved to be restructured for 40 years. And if you look at our public debt size, that the one for the 22.7 trillion, the first tranche, is already reflecting in the public debt. That's why today public debt, size of our public debt as of September is 87.99 trillion. Okay, so we can't overemphasize the need for the central bank to halt direct financing of the government deficit in line with even what is provided in Section 38 of the CBN Act. You don't have to do more than 5% of previous year's actual revenue. Now, your second point is on exchange rate. I am surprised you said somebody suggested the government should fix exchange rate. It's not the duty of the government to fix exchange rate. how can you fix exchange rate when you can't determine supply or demand? Exchange rate is a function of supply and demand. All right. So it is not. That's why the other day, the central bank governor was saying it, and I agree with him. Central bank does not print dollar. Central bank also does not control supply. And as I said, it's not also the government. The government cannot fix exchange rates. It's demand and supply. What the government can do is to also try to see how they can control the demand for dollar by getting us to patronize locally, made goods. Okay, so that's the much they can do. It's not the federal government. On the issue of the global, what to expect, global outlook. Well, if you use the IMF, use the World Bank projections, you're looking at also the projections by the Energy Information Administration in terms of oil price. In the US, for example, the talk now is on rate cuts. The US is talking about reducing the repo rate, which is their Fed fund rate. Okay, so the implication of that is that we expect to see some inflows into developing economies in terms of investments if rates go down in the US. So we should take advantage of those opportunities.
Okay, I think we have to just leave it there. Thank you so much. We are out of time, Prof. Professor of Finance and Capital Market at Nasarawa State University and President of the Capital